Welcome to the Deep Dive. Today we're digging into the first quarter fiscal 2025 earnings call from Karman Space Defense.
Yeah, this is their first full quarter reporting since the IPO back in February, so definitely one people were watching.
We've got the call transcript, the release. We're going to sift through it and pull out the key takeaways for you.
Absolutely. They operate in space and defense, both hot areas right now. This call gives us a fresh look at their performance and, their outlook.
Okay, so let's start with a quick snapshot. How did the quarter look overall?
Pretty strong, actually. A really solid start to their fiscal year. They hit some records.
Records like what?
Well, record quarterly revenue for starters. $100.1 million.
Wow. Okay. How does that compare?
That's up 20.6% compared to the same quarter last year. So pretty significant growth there.
Nice. And did that flow through to profitability? Because top line growth is great.
It did, yeah. They also reported record quarterly adjusted EBITDA that came in at $30.3 million.
Adjusted EBITDA, remind us quickly.
Sure, it's just a way to look at operating profit before things like interest, taxes, depreciation, amortization. Kind of a cleaner operational view.
Got it. And that $30.3 million.
Up 25% year over year. And it represents a 30% adjusted EBITDA margin, which is quite strong.
30 cents on the dollar at that level. Okay. What about earnings per share?
Also look good on an adjusted basis. $0.05 per share, which was up 67% year over year.
So strong growth across the board there. Anything else stand out from the high level?
The backlog. They highlighted a record funded backlog.
Yes, the backlog. Always important. How big are we talking?
$636 million at the end of the first quarter. Funded backlog means, they have the contracts and funding secured for that future work.
And that gives them visibility, right?
Yeah.
Especially being new to the public market.
Exactly. It shows solid execution, momentum from the IPO, and a clear review of upcoming revenue.
Okay, good overview. So, strong start, record revenue and profit, backlog. Let's dig a bit deeper now. Where did that revenue growth actually come from?
Well, what's interesting is that it wasn't just one thing. It was pretty broad-based across their three main segments.
Which are?
Hypersonics and strategic missile defense. That grew 21.1%. Tactical missiles and integrated defense systems. That was the fastest grower, up almost 30%, 29.6% to be exact. And then space and launch grew 12%.
So growth everywhere, basically.
Pretty much. Management did say, things can vary quarter to quarter, but annually they kind of expect space and launch to be about a third of the revenue and the two defense markets making up the other 2/3.
Makes sense. Any specific programs they called out driving that growth?
Yeah, they mentioned GMLRS. That's the Guided Multiple Launch Rocket System for the Army. Big program.
Right.
And NGI, which is part of the Next Generation Interceptor for missile defense. Those were up.
And were some things down?
Yes, they offset declines in other areas, notably SLS, the big NASA rocket space launch system. And they actually said they expect revenue from SLS to be negligible going forward, less than 1%.
Okay, good to know. Now, you mentioned strong margins. Gross margin expanded quite a bit, didn't it?
It did, significantly, up 450 basis points year over year.
So 4.5 percentage points, that's a big jump. What was behind that?
They said it was mainly operating leverage. As revenue grows, costs don't grow quite as fast and just getting more efficient in their operations.
That's right. Scaling benefits.
Exactly.
Now, we should probably address the fact that despite the strong adjusted numbers, they did report a net loss for the quarter. How does that square?
Yeah, that's a really important point. The net loss was almost entirely driven by one specific item, share-based compensation expense, about $8.9 million of it.
Okay.
This was triggered by the IPO in February related to pre-IPO shares. And crucially, management stressed it has no dilutive effect, meaning it doesn't increase the share count. It's really an accounting charge tied to the IPO hitting the G&A line, not a reflection of poor operating performance.
Okay, so an IPO artifact, essentially. Good clarification. Let's go back to that backlog, the $636 million. How much certainty does that give them for this fiscal year, for 2025?
Really high certainty, actually. They said that as of the end of April, so a month after the quarter closed, they already had visibility on about 95% of the revenue needed to hit the midpoint of their full year guidance.
95% locked in already. That's pretty secure.
Yep, very secure. And they expect to book the remaining 5%, which is only about $20 million, from orders on existing programs by the end of this current quarter, Q2.
So they sound very confident in hitting their numbers for the year.
It certainly seems that way based on the backlog.
Okay, what about the balance sheet? Cash, debt.
Cash position looks much stronger. It jumped to $113.7 million, up from just $11.5 million at the end of 2024. That's mostly the IPO proceeds, of course.
Right. Did they use that cash for anything specific?
Yeah, they paid down some debt with part of it, and then right after the quarter ended in early April, they actually refinanced their remaining debt.
Oh, okay. Good timing.
Seems like it. They replaced their old credit facilities with new Term Loan B and revolving credit facilities. The key benefits are it pushes out their debt maturities quite a bit out to 2030 and 2032, and it also lowered their net interest rate, so more breathing room financially.
Smart housekeeping. Okay, anything else for folks trying to model the company? Taxes, capital spending?
Yeah, a couple pointers there. They expect a 24% statutory tax rate for this fiscal year. And for capital expenditures, or CapEx, they're guiding to about 4% of revenue.
And where's that CapEx going?
Investing in growth. They specifically mentioned funding capacity increases and adding new capabilities, like a new clean room out in Washington State and a new facility down in Alabama.
Makes sense. Investing to meet that demand they seem to be seeing. Let's zoom out a bit now. What did the call tell us about the bigger picture, the market, demand drivers?
Yeah, this was a big focus. Management really emphasized how well they feel they're aligned with two major trends. One is the big increase in commercial space activity.
Right, more launches, more satellite.
Exactly. And the second is critical U.S. Department of Defense priorities.
Such as?
Things like homeland defense, needing better missile defense, precision strike capabilities, and significantly expanding space assets for things like surveillance and communication.
And Karman plays in all those areas.
They do. They pointed out they support components on virtually every U.S. space launch vehicle flying today. Things like the systems that hold payloads and release them, or thermal protection.
So if launch cadence picks up like everyone expects...
They benefit.
Yeah.
They mentioned anticipating that ramp up, referencing upcoming launches from ULA and, Atlas V, Vulcan, and others. They threw out a number, like potentially 75 plus launches needed over the next few years across the industry.
Wow. And on the defense side, any specific initiatives they mentioned?
Yes, they highlighted how their capabilities align with emerging government efforts. They specifically mentioned something called the Golden Dome Initiative.
Golden Dome? What's that?
It seems to be a strategic framework focusing on big investments in hypersonics, needing more space assets for sensing and detection, which again means more launches and advanced missile defense.
And Karman's position there?
They feel it's strong. They talked about having over 20 years of flight-proven experience in hypersonics components, and they're already supplying parts for major missile defense programs like NGI.
So it sounds like the DoD budget priorities are flowing right into their sweet spot.
That's certainly the narrative they presented. They pointed to reports of potential incremental DoD funding, maybe $150 billion, for things like unmanned systems and hypersonics. Plus, they noted the recent House Armed Services Committee markup proposed an extra $25 billion for air and missile defense, specifically calling out space, hypersonics, and layered defense.
Those are big numbers.
They are. They expect more clarity on the fiscal 26 budget picture later this month, but the overall trend seems favorable for their business lines.
Is this translating into actual program demand increases yet, or is it still mostly talk?
No, they gave concrete examples. The biggest one was probably GMLRS, that Army rocket system.
Right, you mentioned that earlier.
Yeah, the Army apparently plans to nearly double production, going from 10,000 units a year now up to 19,000 starting in 2028.
That's a huge increase.
It is. And Karman noted that ramp-up has to start well before 2028, meaning increased orders for their components should be coming sooner rather than later. They also mentioned getting positive signals on an air-launched missile program that could significantly boost their production volumes there, too.
Okay, so the demand picture looks pretty robust. What about risks? Did they talk about things like tariffs or government trying to squeeze costs?
They did address those. On tariffs, they said they have minimal exposure. They buy almost nothing directly from foreign suppliers, apparently, and use very few rare earth materials.
Okay.
And for potential cost increases on materials they do buy, they said most of their contracts are fixed price, but renew annually, so they have opportunities to adjust pricing if needed. Plus, direct international sales are tiny, less than 1%, so export issues aren't a big concern.
And the government efficiency drives. Always a worry for contractors.
They actually frame that as a positive for them. Their argument is that their deep IP-enabled vertical integration, basically, doing more manufacturing and development in-house, allows them to be more efficient and faster, which is valuable, especially for critical national security programs.
So they think they can deliver value even if the government is pushing for savings?
That's the idea. And they also reminded everyone that over 90% of their contracts are already firm fixed price, so the pressure's already on them to be efficient.
Okay, makes sense. So wrapping up the outlook, did they stick with their guidance for the full year?
Yes, they reaffirmed it. Full year fiscal 2025 revenue expected between $423 million and $433 million.
Which is what kind of growth?
About 24% growth at the midpoint compared to last year. And adjusted EBITDA guidance was also reaffirmed, $132 million to $137 million. That's about 27% growth at the midpoint.
Strong growth expected for the year then. And they gave some phasing info too.
Yeah, they expect about 48% of that full year revenue to land in the first half. So slightly more weighted to the second half, but pretty balanced.
And their strategic priorities haven't changed.
Nope, sounds very consistent. Focus on sustained organic growth. Keep an eye out for small bolt-on acquisitions, maybe one or two a year, to add capabilities or deepen that vertical integration, invest in their people, and just execute well to be a go-to partner.
Did they say anything about longer-term visibility beyond this year's guidance?
They mentioned that they regularly have discussions with their large customers looking out 3 to 5 years. This helps them plan capacity. They stress that once they're designed into these long life cycle defense and space programs, it's pretty hard to swap them out. They become embedded.
Okay, that covers the call pretty thoroughly. Let's shift gears now. We always do this, take what we heard just from the call and spin out a potential idea. Remember, everyone, this is absolutely not financial advice, just a thought experiment.
Definitely not advice. Purely speculative thinking based on the information discussed. Do your own research, talk to a professional.
Okay, disclaimer delivered. What's the idea?
All right, so you take that really high backlog visibility, 95% for this year already locked in. You take the reaffirmed guidance showing strong 24% revenue and 27% EBITDA growth. You factor in management's confidence about booking the last 5% this quarter. And then you layer on all that discussion about these big tailwinds, Golden Dome, the huge GMLRS ramp starting soon.
Okay, I see where you might be going.
What if?
Okay.
What if the current 2025 guidance, while strong, is actually a bit conservative when you think about the timing of those ramps? Like, GMLRS doubling by 2028 means the buildup has to start well before then, right? Maybe that hits sooner than expected. And maybe Golden Dome turns into real bookings faster than people assume.
So the idea is that the 2025 guidance might not fully capture the acceleration that's coming. Potentially. And here's the slightly outrageous part of the thought. What if management might be deliberately setting the stage to potentially beat expectations significantly when they issue 2026 guidance down the road? You know, build that track record as a new public company.
Underpromise and overdeliver, the classic move.
Exactly. So the speculative thought, again, not advice, is that maybe there's an opportunity based on the idea that the market hasn't fully priced in the speed and scale of the demand wave that seems to be building, a wave Karman seems perfectly positioned for based on their own comments. You're betting that the 2026 outlook, when it comes, could surprise significantly to the upside.
Interesting angle. Definitely hinges on management being conservative and those program ramps hitting faster than implied. Purely a hypothetical based on reading between the lines of this specific call.
Precisely. Okay, let's recap the main points from this deep dive. Karman Space and Defense kicked off their fiscal 2025 with a record Q1. Strong revenue growth across the board, significant margin expansion.
Adjusted profits looked solid, cash position greatly improved post-IPO, even though there was that accounting net loss related to stock comp.
High visibility for the rest of the year, thanks to that massive backlog. They're investing in capacity. And strategically, they seem really well placed for growth in commercial space and key DoD priority areas, hypersonics, missile defense, space assets.
Yeah, management sounded confident about handling risks like tariffs or efficiency drives, and they reaffirmed that strong growth guidance for the full year.
Looks like continued solid performance ahead, backed by the backlog and what seem like pretty favorable market wins.
But remember, as always, this analysis of the earnings call is just for your information. It is definitely not financial advice. Always, always do your own homework and consult with a qualified financial professional before making any investment choices.
Absolutely. So a final thought to leave you with, based on our dive, consider how those specific program increases, like GMLRS nearly doubling, ripple through the supply chain. Does Karman's vertical integration make them capture more value or make them harder to displace as those waves hit? Something to think about.